You have heard the term index fund probably 100 times at this point, maybe more. It comes up in personal finance videos, in conversations about retirement, in articles about how to invest, in that one moment when someone at work mentioned their 401k and used the word index, and you nodded along. And if someone asked you right now to explain what an index fund actually is, like genuinely explain it, not just repeat the phrase, you might find yourself reaching for words that are a little vague. Something about the stock market. Something about how they are supposed to be good. That is completely normal, because most of the explanations out there either assume you already know more than you do, or go so deep into financial terminology that you come out the other side more confused than when you went in. So let's actually fix that right now. By the end of this, you are going to understand what an index fund is clearly enough to explain it to someone else, which is the real test of whether you actually understand something. If this is the kind of plain English money breakdown you want more of, subscribe and give this a thumbs up. It genuinely helps. Now, let's get into it. The first thing to understand about an index fund is what it is not. Because clearing up what it is not makes the actual explanation click a lot faster. An index fund is not a stock. When you buy a stock, you are buying a small piece of one specific company. You buy Apple stock, you own a tiny fraction of Apple. The value of your investment goes up and down based entirely on how Apple does as a company. If Apple has a great year, your investment grows. If Apple has a terrible year, your investment shrinks. One company, one bet. An index fund is not that. An index fund is also not a savings account. A savings account gives you a fixed or variable interest rate, and your money is guaranteed, or very close to guaranteed, by the bank. Safe, stable, predictable. An index fund is not that either. The value of an index fund goes up and down with the market. Some years it goes up a lot, some years it goes down. It is an investment, not a savings vehicle. What an index fund actually is, and this is where the clarity comes in, is a basket. Imagine you walk into a grocery store, and instead of buying just one type of fruit, you buy a basket that contains a small amount of every fruit in the store. One apple, a few grapes, a banana, some strawberries, a bit of everything. Now, your basket's value does not depend entirely on how any one fruit is doing. If apples have a bad week, it does not destroy your basket, because you also have grapes and bananas and strawberries. Your basket moves with the overall health of the fruit section, rather than with any single fruit. An index fund works the same way. Instead of buying one company's stock, you are buying a tiny piece of many companies simultaneously. When you put money into a broad index fund, you might own small slices of hundreds or even thousands of companies at once. Your investment does not live or die based on any single company's performance. It moves with the overall health of the market that the fund tracks. Now, the word index is the part that confuses people, and it does not need to. An index is just a list, a specific defined list of companies that someone decided to track. The most famous one is the S&P 500. The S stands for standard, the P stands for poors. The 500 is the number of companies on the list. The S&P 500 is simply a list of 500 large American companies. Companies like Apple, Microsoft, Amazon, Johnson & Johnson, Visa, Coca-Cola, big established American businesses across many different industries. The S&P 500 index tracks how those 500 companies are collectively doing. If those companies are collectively growing and profitable, the index goes up. If they are collectively struggling, the index goes down. An S&P 500 index fund just owns those 500 companies, or a very close approximation of them, in the same proportions they appear on the list. When you buy a share of an S&P 500 index fund, you are not picking which of the 500 companies you think will do best. You are buying all of them at once. The whole list, the entire basket. This is fundamentally different from stock picking, and the difference matters more than most people realize. When you pick individual stocks, you are making a bet. You are saying, I think this company specifically is going to do better than the market expects. That bet might be right. It might be wrong. And even very smart people with enormous research budgets get it wrong more often than most people realize. There is decades of data showing that the majority of professional fund managers, intelligent, experienced people who do this full time, do not consistently beat a simple index over long time periods. Not because they are not smart, because predicting which companies will outperform in a market full of other smart people trying to do the same thing is genuinely hard.
An index fund does not try to beat the market. It tries to be the market. And being the market, owning a broad slice of the whole economy rather than betting on specific parts of it, has historically produced better results for most long-term investors than the alternative. Now, there is another reason index funds have become as popular as they have, and it is not just about the returns. It is about the fees. When you invest in an actively managed fund, a fund run by a professional manager who is researching and selecting specific stocks, that manager charges you a fee for their work every year, regardless of whether they beat the market or not. That fee is called the expense ratio, and it gets expressed as a percentage of your investment. An actively managed fund might charge you somewhere between 0.5% and 1.5% per year. An index fund does not need a team of analysts deciding which stocks to buy and sell. It just follows the list, which means it can charge dramatically less. A typical S&P 500 index fund charges somewhere around 0.03% to 0.10% per year. That difference between 1% and 0.03% sounds small. Over 30 years, it is enormous. Here's what that actually looks like with real numbers. Say you invest $10,000 and it grows at an average of 7% per year for 30 years. With no fees, you would end up with roughly $76,000. With a 1% annual fee, your effective return drops to 6%, and you end up with about $57,000. The 1% fee cost you nearly $19,000 over 30 years on a $10,000 investment. Not because of bad investment decisions, just because of the fee compounding against you, the same way your gains compound for you. At 0.03%, the fee impact over 30 years on that same $10,000 is roughly $650. The index fund investor ends up with close to $75,000. The actively managed fund investor ends up with $57,000. Same market, same starting amount. An $18,000 difference from a number that looked tiny. This is why the fee conversation is not a minor footnote when you are choosing where to invest. It is the main event. Now, let's talk about what the actual numbers look like when someone starts using an index fund properly. Because the real case for index funds is not just about avoiding high fees. It is about what consistent investing in a broad market fund does over a long time horizon. If you put $200 per month into an S&P 500 index fund starting at age 25, and you do that consistently until you were 65 at a historical average return of around 7% per year, you end up with approximately $525,000. You put in $96,000 of your own money over those 40 years. The remaining $429,000 is growth. Compound growth from consistently investing a modest amount in something that tracks the broad market. If you wait until 35 to start the same habit, same $200 per month, same 7% average return, you end up with roughly $243,000 at 65. You put in $72,000 of your own money. The remaining $171,000 is growth. Still meaningful, but the 10-year head start is worth about $282,000 in this scenario. Not because the person who started earlier is smarter or invested better, just because they started earlier and let the compounding run longer. This is the actual argument for index funds. Not that they are exciting, not that they will make you rich overnight, but that a boring, consistent investment in something that tracks the broad market over a long time period produces meaningful wealth for people who are not doing anything special except starting and staying consistent. At this point, a lot of people have the same objection. What if I want to beat the market? What if I want to do better than the average?
Why would I settle for just tracking the index when I could pick better stocks and get better returns?
That is a completely reasonable question, and it deserves a completely honest answer. The honest answer is that you might be right. Individual stock picking can produce extraordinary returns. There are people who have done it. Warren Buffett exists. The possibility of beating the market is real. But the probability of doing it consistently over a long period of time is much lower than most people believe when they are starting out. And the cost of being wrong, spending years picking individual stocks, underperforming the index the whole time, and ending up with less than the boring index fund strategy would have given you, is real. And it happens to a lot of smart people who thought they would be the exception.
The index fund is not the strategy for people who do not know enough to do better. It is the strategy that the majority of evidence over decades in multiple markets suggests beats most alternatives for most people over most time periods. It is what many of the world's most sophisticated investors recommend for the portion of their own money they are not actively managing. Not because they cannot do better, because the evidence for the alternative is thinner than the confidence behind it usually suggests. So how do you actually buy one? Because understanding what an index fund is and knowing how to get your money into one are two different things.
The practical answer is simpler than most people expect. You need a brokerage account. If you have a 401k through your employer, you already have one. You just need to look at the investment options available in your plan and find the one with the lowest expense ratio that tracks a broad market index. Usually the S&P 500 index fund or the total stock market index fund. Those two words, index fund, and a low expense ratio number near 0.03% to 0.10% are what you are looking for. If you are opening your own account, a Roth IRA, a regular brokerage account, you can do that through any of the major brokerages. Fidelity, Vanguard, Schwab, all of them offer S&P 500 index funds with very low fees. You deposit money, you buy shares of the fund, and then you leave it alone and let it do its thing over time.
The most important step is not picking the perfect index fund between two options that are basically identical. The most important step is starting. Because the compounding that turns $200 a month into $525,000 starts on the day you buy your first share, not on the day you finish researching which brokerage has the marginally better interface. One more thing before we finish. Simple is not the same as dumb. The index fund strategy is simple. It requires no expertise, no research, no constant monitoring, no special knowledge about individual companies or sectors or economic cycles. You buy a broad index fund, you add to it consistently, you leave it alone.
That simplicity is not a consolation prize for people who do not know enough to do something more sophisticated. It is the strategy. The evidence for it is stronger than the evidence for most alternatives. The people who understand investing most deeply are often the most enthusiastic advocates for it. If you can explain to someone else what an index fund is, how it differs from picking individual stocks, why the fee difference matters so much over time, and roughly what consistent monthly investing in one might look like over 30 years, you now understand this better than most people who have been investing for years. That is not a small thing. That is the foundation of a financial life that actually works.